It's Brian Preston, the money guy.
I've heard you say this for almost as long as I've known you, is it is very difficult to build wealth if all you do is rent your life. And you said that there's a big difference in owning versus renting when it comes to long-term wealth building.
Well, yeah, think about it. I mean, there is something, I know when I worked in governmental planning and other things like that is that you want to know which of your residents are transient versus which ones are setting roots and building their family there. It's kind of the same way with investing and building assets. When you own something, you also now have a portion that can appreciate. You can get the benefits and the fruits of that down the road. When you're renting, you are susceptible. You get maximum flexibility. I don't want to underestimate the value of that flexibility, but in this runaway inflationary period, you are missing out on a lot of that upside.
Now, for most folks, the single most valuable or largest asset, largest quote-unquote investment, largest purchase they will ever make is a home. But for everyone, before you can be a homeowner, you have to buy your first home. You have to wade into those waters. And one thing that's really, really unique right now is it has become possibly maybe more difficult than ever that buying your first home today is not quite as easy as it was in years or decades past.
Yeah, this is where you always accuse me of getting on the soapbox a little bit, is because I do think there's some really scary trends going on. Let's first put a shock and awe stat and graph up, and the fact that if you compare the cost of housing to the increases in wages, you can see there's a complete inverse disconnect between these numbers.
Starting at about 2020, right?
That is very scary because you see housing costs is going through the roof. You know, it makes complete sense with the inflationary pressure and some other things I'm about to talk about. Meanwhile, wages have been going down. That's not something that brings a lot of comfort, especially for somebody who's trying to get their first home. And I want to talk about, and this is something, look, BlackRock has been the poster child on institutional home buyership, where you have these big institutions that are going out there and buying a lot of the starter home community inventory. I do think this is a trend I don't love, and I'm going to talk about navigating this in a second. But here's why I have an issue with this, and we've had a lot of internal discussion on this because there's a lot of people say it's capitalism. It's good, and everybody knows I am definitely a capitalist. I definitely think that when you have that invisible hand that Adam Smith talked about in Wealth of Nations, it does keep a lot of people in check. The system self-corrects itself. There is a problem, though, with what's going on currently. It's not a true marketplace. If you want to know what's going on, think about this. Historically, and in a healthy marketplace, somebody who's buying a house for themselves, like a first-time home buyer, they are going to get a better interest rate than an investor gets, because if you're the bank that's underwriting this loan, you look at somebody who's going to be moving in with their family, going to be, that's their shelter at night. You go, man, they have a lot of skin in the game, and the fact that they're probably going to want to pay that bill more than anything else because they don't want to lose their house. Whereas you're always worried about investors is because they're not sleeping in that house at night. They're putting in renters. You're like, well, that's a riskier behavior. So I'm going to underwrite that completely different. And because it's underwriting different, it's going to have a higher premium on the interest rate than what a person who's buying this for their primary residence. That's normal, historic, good ways, so it gives you, the first-time home buyer, like you're on a level playing field. You even get an advantage with a better interest rate. Fast forward to the situation of artificial interest rates, which is basically fake, is that the government is manipulating interest rates to where institutions are getting rates, and Daniel found this number for me, as low as 1.4%. Now, look, Bo, we're pretty successful guys. We bought a building recently. Did we get 1.4%?
We did not get 1.4%.
So that is a huge disconnect in the fact that you have big institutions through manipulated marketplaces that, because the government's artificially keeping rates because they have their own debt issues, that it is undercutting what the typical first-time home buyer can do. And that bothers me, because this is the problem is, and I want to play this out, because a lot of people who will say this is just the market, they'll say this is such a small percentage of the marketplace. They'll be like, BlackRock is only buying just a few percent. They're buying like institutional investors are buying 15% of all homes sold. That still leaves the other 85%.
It sounds like a relatively small portion of all homes
Here's
sales.
the problem. First time or starter home communities, these are your homes that your first time buyers are buying. They account for about 21% of the housing marketplace. So you can understand very quickly if that is the key marketplace that you're seeing the institutional investors go for, you are seeing a big distortion. And it's not uncommon. Daniel found for me, there are zip codes in the United States right now that 90% of homes that are available are being gobbled up by the institutions.
So what's happening is these large institutions that are able to access capital at very low rates are going and snapping up homes that most likely, most often would have been bought by first-time home buyers, folks that are getting on the ownership side of the equation. And Brian, this is especially close to you and I because we have a lot of young team members here who are early on in their careers. They're trying to save up for their first home. They're trying to get on the equity side of the equation, and it's almost like they're chasing a car that's running away from them.
Yeah.
Because of these institutions coming in, because of the super cheap money, the prices of homes keep getting higher and higher and higher. That first-time home purchases become a much more difficult thing to acquire, so they are forced into this position of being renters year after year after year, even though they would perhaps rather buy otherwise.
And what I don't like is the narrative. You hear so much division between those who have and those who don't in this wealth gap. And people will talk about tax policy and other things that are creating wealth gap. I think this is actually what creates wealth gap. It's not necessarily the tax policy. It is the fact that you can allow people who have assets, they are continuing to appreciate and take advantage, and this inflationary pressure is causing their assets to appreciate. Meanwhile, artificially low interest rates is not only hurting the savings rates that people who are initial savers who don't know about the power of investing, they're being held down through this process. It creates a bigger and bigger divide. This is a problem, and the thing that now we're going to give the facts on how you navigate through this. But systemically, this is a problem because our government has so much debt.
Now, obviously, there are times when renting versus owning is caused by something outside of your control, outside of your circumstance. But we also do live in a society now where sometimes even the decisions we make can push us deeper into that hole. We know that the average auto loan term for new cars is about 72 months right now. So most people don't even drive their cars for this long, yet they're borrowing money to pay for the automobile for 72 months. And Daniel let us know this fact, that 1 in 3 people who trade in a vehicle are actually underwater in their auto loans. They are rolling negative equity into their new loan. If you're on that course, if you are participating in auto ownership that way, you are never, ever, ever going to own your automobile.
I gave you guys a lot of fodder and a lot of ammunition on why the system is working against everybody who's trying to get into their first home. This one is completely self-inflicted. And this is the part, be very careful of falling prey to the consumer society. I want you to be a wealth builder. Don't just fake your life. Faking it until making it sounds great in a commercial. It doesn't actually create wealth.
And it's not just on big purchases like housing and like automobiles. It's also on the everyday purchase. We know that right now, half of Americans, 47%, according to Experian, of credit card users carry a balance from month to month, and the average American with credit card debt owes about $5,300 on that debt right now. Again, this is just one more example of folks borrowing or renting their lives instead of owning their lives. If you are borrowing it, you are not building wealth. So it is likely that you are feeling poorer and poorer and poorer as that hole gets deeper and deeper and deeper.
Well, I think it gets worse in the fact that I know when I'm using shopping apps, even you could do stuff as like Amazon and others. I am shocked by how many things, just household things that you're buying that are less than $100, they'll say, hey, do you want to pay for this in 4 easy payments?
Yeah.
You're like, what?
Yeah, I feel like Amazon asks me that all the time.
But here's the sad thing. 56% of Americans have used buy now, pay later services. Guys, faking it until you're making it, kicking it down the road a little bit is not the way you create wealth. Be very, very fearful when you use these type of tools. So let's pivot, Bo, because I felt like we've given a lot of ammunition to the negative side of things. Let's talk about, how do financial mutants actually navigate this?
Yeah, I think the first thing, we started talking about housing, and you know that we love putting 20% down on a house because, one, it allows you to have equity in the home that you purchase. It allows you to get the monthly note down, and it allows you to avoid additional costs like primary mortgage insurance. However, when you buy your first home, getting to 20% might be difficult, especially if you're in one of these white-hot real estate markets where the price of housing keeps going higher and higher and higher. So we give you a little reprieve. When you buy your very first home, you don't have to put down 20%. It's okay if you do a 3% down payment, a 5% down payment, a 10% down payment, so long as you make sure that the cost of your mortgage, the monthly note that you pay, is less than 25% of your income. So long you stay inside that guardrail, it's okay on your first home purchase if you don't hit that 20% down payment mark.
Yeah, and I would even couple that with some of the house hacking stuff. I mean, if you could buy a duplex and have somebody else pay a portion of your mortgage, or you get roommates, get creative so you can overcome some of these unique things that are going on right now when you couple inflation with artificially low interest rates.
On the auto side of things, and the car side of things, we want to make sure that you follow the 23-8 rule. When you buy a car, we want you to put 20% down. We don't want you to finance it for any more than 3 years or 36 months, and your monthly car payment cannot be greater than 8% of your gross income. Now, there's another little caveat that you throw on there regarding investing and where you have to be with your investing related to your car payment.
Yeah, I definitely want your monthly investments to exceed your car payment. If you have that backwards, it blows my mind when I hear about people who have an $800 a month car payment, but they're only putting $300 a month in their investments.
Not where you want to be.
What are you doing? Don't fake your life. That's not going to create success. And the same thing can be said about credit cards. Look, you guys know we do give you grace on the fact that you can use credit cards as a tool, and that's a privilege. That's not something that I consider a given, because credit card debt is a no-go land. If you actually can't pay off your credit card every month, if this thing is stressing you out to where you're actually spending more and then paying interest, it's no-go land, and I'd rather you go to more of a cash or debit card strategy than using credit cards. So don't actually waste that privilege and run up credit card debt.
And the last thing I think that a financial mutant can do to help stave off some of these issues is don't lose your mind. Don't forget your rational, cogent, logical mind that makes you do something like, oh, it's so hard to get a house. I'm going to go buy a house with no appraisal, and I'm going to waive the inspection, and I'm going to give this concession and that concession. Don't get in such a rush that you cause yourself to make a bad financial decision. Don't start thinking, oh, this car that I found a lot, it's the only one, and so I don't care what they're charging me. I'll pay MSRP plus. That may not be necessary. Don't allow the unique circumstances of today cause you to make a decision that's going to impact you for many, many months and years and possibly decades into the future.